Today, we're going to be covering understanding FAR overhead rates and audits. Let's make sure my slides can progress. My name is Charla Roth. I am a CPA here with Dannible and McKee, I'm a partner here. I have over 23 years of experience providing audit, accounting, and consulting services for a variety of clients, specifically architecture and engineering firms. I work extensively under the FAR, Federal Acquisition Regulation sector, performing overhead audits. I manage a large contract with the New York State Department of Transportation, performing contract closeouts and pre-awards. On the other side of my clients, doing that for other engineering firms that the DOT contracts with. So a lot of experience with various software packages, Deltek, Azure, QuickBooks. Excited to present to you today. Just wanted to let you know a little bit about Dannible and McKee in case you've never participated in one of our webinars. We are a full service CPA firm that delivers superior outcomes throughout a combination of technical knowledge, deep understanding of our clients, and commitment to personal responsive service. Our clients consist of clients across New York State and the United States. I have clients all the way to California, Alaska. Some of you are on today. We have offices in Syracuse, New York. We also have offices in Binghamton, Schenectady, and Auburn, New York, as well as Tampa, Florida. We provide assurance, accounting, tax, forensic, valuation services. We service AE industries, which I mentioned, automotive, construction, healthcare, manufacturing, nonprofit. We cover all those areas. I want to introduce you to DM Consulting Group, which is previously known as Dannible, McKee and Associates. We had some rebranding this year. Hopefully you like our new logo. We have gained some national recognition as one of our leading accounting consulting firms within the AE industry. For over 40 years, we've been consulting with firms throughout the country to determine the fair market value of your firm. We've performed many valuations and ownership transitions, creating really specific strategies to transfer that ownership within establishing buy and sell agreements to the owners of your firm. So if you're interested in any of those services, please contact me and I will get you in touch with the folks over at DM Consulting. We do actually have a few webinars coming up that I wanted to promote. We have Successful Ownership Transition for Design Professionals. It's a comprehensive one-day seminar developed for partners, shareholders, associates, and the architecture and engineering firms who need to value their firm for sale, acquisition, or merger. So we have some full-day seminars, but we also have some half-day seminars if you're interested in those. And we're going to provide all of these slides to you by email afterwards. So don't worry about writing any of this down. But you can always feel free to reach us at our website, dmconsultingseminars.com. So let's jump right in. So today I'm going to talk to you about navigating through the complexity of FAR overhead rates and audits. So over the years, we've seen more and more architecture and engineering firms really finding that they're going to need an audited overhead rate that's in accordance with Federal Acquisition Regulation, FAR. We're just going to call it FAR from here on going out. Lots of trends leading to this, including the economic shutdown that reduced any development projects, causing more firms to really shift their interest into government. So several years ago, the AASHTO came together and developed this guide we're going to cover a little bit about what that guide is, that really brought all the entities together, all the state agencies, all the federal agencies together, and develop this manual about how to properly calculate and audit FAR overhead rate. So when we say FAR, so I talked about, that's an acronym for Federal Acquisition Regulation. And there's really a specific part of FAR that we're concerned with. That's called FAR Part 31. And that's the Contract Cost Principles and Procedures, subpart 31.2 to be exact. The FAR itself is huge. It's 1,900 pages long. It's a massive read. But the FAR Part 31 is only 50 pages, and that's what's specific to a FAR overhead. audit. So that's 50 pages, very doable. It's a good read. There's also some other resources out there that we're going to talk about. I want to just get some of this terminology with you. If you have any defense contracts, you've probably dealt with the DCAA, and with them, they follow the FAR cost principles and the DCAA contract audit manual. One thing else you might hear is CAS referred to. That's your federal cost accounting standards. If you deal with any federal contracts, you may hear that word CAS, just to be familiar with that. And we've already talked about a little bit about AASHTO Uniform Audit and Accounting Guide, which I'm going to talk to you about more next. So what is AASHTO? AASHTO stands for the American Association of State Highway and Transportation Officials. So in September 2001, AASHTO and their audit subcommittee got together and issued this initial uniform audit and accounting guide. So this guide's designed to assist engineering consultants, independent CPAs like myself, and state departments of transportation to prepare or audit the statement of your direct labor, fringe benefits, and general overhead. So these statements are commonly referred to as your FAR overhead statements or your FAR overhead audits. And this main purpose is to calculate your firm's overhead rate in accordance with the standard FAR Part 31. So this AASHTO guide was great. So they came out with this guide in 2007, brought all of us together and said, hey, we all want to get on the same page. We don't want different states doing different things. So this guide is meant to unite all of the agencies to ensure that we're all on the same page. I think there were some subsequent revisions after that, after we had some thoughts, 2010, 2012, 2016, and now we're at 2024. So 2024 is the most recent edition. Not a lot of changes in that 2024 edition that relate to you. It's mostly for myself as an auditor. So the purpose of this is that the states all agreed that they'd give up their specific rules. So many states, you would go state to state to state if you're a large firm performing work, and your FAR audit wouldn't be the same as what they need in, Vermont versus New York or California versus Alaska. So it was very important to get all the states on the same page because it was creating such a nightmare for firms, making sure they comply with all the state standards. So this guide is really meant to solidify the agreement amongst the states. Now, I understand some states still do things a little wonky and maybe they have some specifics, but for the most part, they've done a great job at really accepting and embracing the AASHTO audit guide and following those standards. So what this was meant to do was it was also giving guidance to us as CPAs on what they wanted us auditing and clarifying that. So this is going to hopefully provide increased reliance on your CPA's FAR audits. Before, you would get these audits done and then they would go and they'd re-audit. So hopefully now the states are relying more on those CPAs because they're all in agreement that they're following the AASHTO audit guide. So some small firms may be exempt from a CPA audit if the home state DOT conducts a risk assessment and ensures the rates are in accordance with FAR. So you may not be at that point where you need that FAR audit yet. Like New York State, it's $1 million in gross revenue, which in today's day and age is not that much. However, that's the trigger point. So if you've had $1 million in gross revenues for, I think it's 2 years in a row, then you're going to trigger an audit. So new guidance in determining reasonable compensation costs. This is something that came out in this new AASHTO guide that AE firms should prepare their own independent compensation analysis. So this guide's going to help you do that. We utilize what we call this national compensation matrix, which was provided many years ago, and it gets updated every year. But we refer to this as the NCM, the National Compensation Matrix. And this is what you should be comparing your compensation to determine it's reasonable under AASHTO. So this guide also recognizes the unique nature and complexity of a FAR audit engagement, and it really provides the CPA with specific standards to perform. FAR is very gray in many areas. If you read those 50 pages, you may be more confused than before when you started. So this AASHTO guide really kind of comes in and gives specific examples and really outlines and clarifies those gray areas. So understanding a FAR and establishing contract terms. And I should point out, my marketing department is messaging me saying, hey, make sure you point out if they have any questions, you can put them in the chat. I will try to address all the questions beforehand, before we end. But if I don't, I will email you all separately on your answers. So fear not if I don't get to the questions, but that chat feature is there for you, or the Q&A. Feel free to reach out. And again, in case you joined late, we're going to provide all these slides to you in advance. So understanding your FAR. Determining a FAR overhead rate is nothing new for most of your firms. You've probably developed an overhead rate. But for some that are beginning to perform services for the government, the complexities of the FAR is pretty confusing. So without proper guidance, firms could be at a disadvantage of negotiating your contract. You could be leaving money on the table in dealings with your government customers. So it's critical that you understand FAR and that you're preparing your firm's FAR overhead rate properly. So if you don't need an audit yet, it's really important that you're still looking at your statement from a FAR standpoint and ensuring that that rate is appropriate and that you're not leaving money on the table. So one thing we see firms that are just starting to do work in the government realm is that you're getting stuck with this estimated rate. So many firms inexperienced with dealing with FAR don't have a thorough understanding of your overhead rate and how to calculate those disallowances. So rather than properly determining an overhead rate, you're ending up with an estimated FAR overhead rate that's being determined by the state. So you could be sure that if that's the case, those estimates are going to be conservative and in the favor of the client, not to you as the firm. So let's work together to ensure that you're getting the best rate when you start off with those contracts. So one thing I hear all the time, Charla, how can I maximize those overhead rates? So this is a funny question. So let's walk through this. So how can we maximize our overhead rate? So what does that really mean, and does it make sense? So yes, it is critical that you're properly calculating your overhead rate using the correct direct labor base, which is the first part, and ensuring that all allowable overhead is in there, that you're not disallowing any items that should be allowable, which is thereby maximizing your FAR overhead rate. However, remember that on a cost plus job, you're only being reimbursed for the overhead. You're not profiting from it. So on those jobs, there may even be caps on your overhead rate. So when you say maximizing your overhead rate, you want to make sure you really understand what that means. So you may have a mix and have lump sum contracts. So in addition, any additional overhead that you spend when you want to maximize your overhead rate, you're going to be reducing your firm's profit on those lump sum contracts. So keep in mind that your goal is always to control your firm's overhead, not to incur unnecessary expenses. So rather than thinking about maximizing your FAR overhead rate, it might be better to minimize the disallowances between your actual overhead and your FAR overhead rate. Okay. Another important consideration is how FAR overhead rate compares to others in the industry. So I mentioned earlier, you might be capped out, you might be boxed out of that rate. So it's really important that you understand where you are in the market, because a government contract may be awarded based upon a lower overhead rate. So you want to make sure that you're within those median rates within your industries. There's great industry guides out there, including FAR rates by your region, by your size, by the state. This is just a quick example from PSMJ. that I wanted to share with you. This is saying, a median-sized firm or a median firm, 21 to 50 employees, say you're at roughly 182% for a median rate. Okay, and again, I'm going to provide all these slides to you so that you can see this and compare where you're at for your size firm. All right, so what's my first step? So you're getting ready to be entering this FAR realm, and what is your first step? The first step is really making sure that you have a proper financial statement. So your internal statements are the first step to really developing a good overhead rate. So ensuring that your trial balances within your accounting software is formatted properly. So it's critical for an AE firm to establish a good chart of accounts that's and that's not going to just be for calculating your FAR overhead rate. I think it's important that you have a good chart of accounts for your billing and analysis of job profitability, preparing effective internal financial statements, and that it's going to allow you to compare to industry standards. So if you don't have your formatted financial statements in proper form, you can't compare yourself to an industry that does. So it's really important that we get that piece set first. The financial statements of a firm should be the proper format for AE firms specifically. So that's going to be your direct labor and other direct expenses being separated from your overhead expenses, your indirect expenses. This quickly allows you to determine your firm's overhead rate. So you can just look at your statement and know what your base rate is. And it's going to allow you to compare and contrast to other comparisons from other industries. So this is a sample income statement in a general format. This is what you'd see for, manufacturer, or just if you're using QuickBooks, this is a very basic, this is how your setup is going to be. And it's important that you recognize that this is not what an AE statement should look like. This is, revenue, cost of sales, gross profit margin, and then all of your general administrative expenses. If you look at this is an AE statement, okay? So you've got your gross revenues on top, any reimbursables coming down to your net revenue. Then the next piece is really important, your direct labor. When we first talk to firms that are, looking for some help with their chart of accounts, the first thing we do is looking at that direct and indirect labor. So many firms are not breaking out that billable labor, that direct labor, and their indirect expenses, their overhead. So that's really important that we focus on that piece first. Hopefully you have the ability to determine what that direct labor base is, because that's the main component in calculating your overhead rate. So you can see this is a much different statement than this statement, okay? And this is what, if you're going to compare to the PSMJ, you're going to be using that net revenue number. It's really important, especially if you have a lot of subcontractors that this is the format that you're utilizing. So you're getting down to that net revenue base, looking at that direct labor, looking at those indirect expenses. So there was a question out there about the revenue trigger for California. So that's interesting. It seems like there is not a standard number like there is for New York State. I have clients that work with California, and I'm surprised that they don't need a FAR audit, that we just provide them what we call a FAR compilation, and that's acceptable to Caltrans. I don't know what that number is. So, again, I think they're going to work with you. They're going to tell you what they need. I don't think it's that $1 million mark like it is here in New York State. So, we can chat more offline if you want on that. So what does FAR stand for? So Federal Acquisition Regulation. Okay, so that's a really long name. That's why we've given it a nice acronym. So it's FAR. Okay, you're welcome. All right, so the chart of accounts. So I'm going to harp on that a lot because those have to be formatted to allow for a quick and efficient determination of your overhead rate. So again, if you don't have that direct labor separated out from your indirect labor, you can't calculate an overhead rate. Okay, so that's the first piece. And again, getting those direct expenses moved out of your overhead, really important. You can't have direct expenses that are charged off to contracts or that are direct to a project. Even if they're not billable, they're still considered direct. Those have got to get moved out of your overhead, your indirect expenses. So what does a FAR statement look like? This is what it looks like. You don't see revenue on here. You don't see direct expenses on here. It is just your indirect expenses, which includes your indirect labor, rent, depreciation, office supplies, etc. And then it's your direct labor base. That's it. That's all that it takes to correctly calculate your overhead rate. So you'll see what we do is we start off on the left-hand column with this indirect expenses that are coming right from your financial statements. And then we have this column to the right of it called FAR adjustments. So this is the disallowances under FAR that the government just says, hey, we're not going to reimburse your firm for it. They may be allowable expenses under the IRS standards, but we as a government agency, we're not going to pay for those. So they're going to throw out certain things such as, certain bad debt expense or advertising costs. We're going to go into those more. But then you come to this final column to the right. This is going to have your final allowable expenses under FAR on the right-hand column. So you'll see that our original rate was $175, but we had all of these disallowances, $104,000 of disallowances. That brought our rate down to $152. And that's going to be the rate that the state or federal agency is going to reimburse you for. So I talked about this word disallowances. So there are certain things that, the state agencies and the federal agencies are not going to pay for. And this section, FAR 31.2, outlines all of those disallowances. And it determines what's unallowable and allowable based upon those items. So what is allowable? So an allowable charge under FAR 31 is anything that's reasonable in amount, it's applicable to a government contract, it's in compliance with generally accepted accounting principles. Okay, so you may have heard that called GAAP, okay, generally accepted accounting principles. It's compliant with the terms of the contract and not prohibited by any items under FAR 31, okay? So what are some of those common disallowances that they're just not going to allow? Advertising, we talked about that. Bad debts, contributions, so donations to your charitable organizations, write-offs of bad debt, meaning receivables that are not collectible from customers, personal use of company vehicles, and this includes any time commuting from home to the office, not allowable. Fines and penalties, they're not going to pay for your fines and penalties. That one's pretty obvious. Lobbying and political activities, they don't care what you want to lobby or what political parties you support. And then interest expense. So when I am working with my staff and we're talking about the disallowances, it's very much common sense. So what is the government going to want to pay for versus what they're willing to reimburse you for? They don't care about what you need to do to go out and advertise. They don't care that you didn't collect a bad debt because they're paying you. So they don't care if your private sector isn't paying you. Contributions. So they do not care to donate to charitable organizations. That's your prerogative. Certainly allowable under the IRS standards, but they do not care under FAR. So those are some of the common sense ones. So many of these disallowances are very straightforward, common sense. Interest, expense, bad debts, donations. However, there's a lot of nuances related to other disallowances that may be have to be carefully considered. So one instance is determining the disallowance of marketing costs. So many firms mistakenly disallow all their marketing salaries as part of advertising and promotion. However, direct sales type marketing, including bid and proposal costs, are generally allowable. Okay, so it's really important that you work with your CPA firm to look at those types of costs, break them down, work with your marketing director, work with your principals to ensure that if they're working on bid and proposal type work, that you're separating out that time and those costs from general marketing. Okay. If you go and attend a trade show, that's marketing. But bid and proposal type stuff, that's not, that's direct sales and that's allowable. So one thing that we see disallowances are is travel. So it's really important if you own your vehicles that you're maintaining mileage logs. Okay, so it's really important because you need to determine, what's considered personal mileage. So if your partners have vehicles that are under the business, you pay for those leases, or they're fixed assets, you have own them, you need to ensure that you're accounting for that mileage appropriately. Not only is it important for the IRS, but for the FAR. I've seen many state agencies come through. If you don't have proper mileage logs for your company-owned vehicles to demonstrate what's personal mileage, commuter mileage, and what's mileage to and from a client, then they're going to disallow 100% of those costs. So very important. Travel and entertainment expenses. So another area where poor documentation can lead to disallowances. So often, if you don't have proper receipts, meaning itemized receipts, you're going to have that cost disallowed because there's no way to know what is there alcohol as part of that receipt. You have to, alcohol is unallowable under FAR. That's obvious. What's the nature of that travel? What's the nature of the meal? Entertainment is unallowable. That's obvious. They're not going to pay you to entertain your staff or clients. So it's really important that you have, if you're having your staff fill out expense reports, that they're detailing out the nature of the expense and was it business in nature? What was it for? Really important. All right, so another area we talked about was reasonable compensation. So you have this reasonable compensation analysis that the government's not going to pay for excessive salaries. They're just not. There's caps, and they've gone through and put together this national compensation matrix to ensure that your highest compensation employees are not falling above these rates and that they're not going to exceed these reasonable levels, what they determine reasonable, okay? So FAR indicates that compensation for personal services is allowable subject to general criteria. So compensation is a really gray area. They have put this compensation matrix out there to help eliminate some of that grayness. But compensation for personal services must be for work performed by the employee in the current year and must not represent retroactive adjustment for prior year salaries and wages. So you can't go the following year and pay bonuses that were based upon the prior year. You can't defer compensation. That's unallowable. So total compensation for an individual or job class of employees must be reasonable for the work performed. However, specific restrictions on individual compensation may apply. So the compensation must be based upon and conform to the terms of the condition of the contractor's established compensation plan. So it's really important that you establish, if you're paying out bonuses, it's important, raises, it's really important that that's all properly written down. You have a bonus plan and written that you're following and adhering to. So total compensation, when you're looking at what's reasonable, it's going to include wages, salaries, bonus, any deferred comp, any employer contributions to the pension plans, 401k plans. So it's all compensation that we're going to consider when we're determining reasonableness. So you can't just pay them a decent wage and then flush it all through bonuses at year end. That doesn't work. It's all compensation considered into this. And especially if a lot of state agencies challenge bonuses, particularly in New York. It's really important that you have those bonuses documented, that they're within accordance with your performance plans, their performance base. It's just really important that you follow that. So Chapter 7 of the AASHTO Guides really does a great analysis of reasonable compensation. So you should take a look at that. Factors to consider, the size of your organization, the industry, the geographic area. So the national compensation obviously is taking it from, the entire United States, and it is based upon gross revenue. So it does adjust based upon the gross revenue for your firm. You could drift away from that national compensation matrix and perform an analysis based upon several national published surveys, such as PSMJ's, WEG. It's a much more difficult analysis, so that's why most firms tend to use this national compensation matrix. So what does this national compensation matrix look like? And here it is. Hopefully you've seen this before. Excuse me. If not, here's what one looks like. So you're going to have your top highly compensated employees listed, their salary, their bonus, deferred comp, and then it's going to compare to a reasonableness test. And you can see here that our reasonableness did exceed what we were paying them. So we had an adjustment at the end of the day of $168,000 to compensation because it was considered in excess of reasonableness. All right, so there's also what's called this bipartisan cap that you have to follow. So in 2025, that cap is $671,000. So no matter the size of your organization, the government has come through and said that no employees will be reimbursed in excess of $671,000. You can pay them in excess of $671,000. We're just not going to reimburse you through your overhead rate in excess of that. Okay. So I want to address what this facilities capital cost of money. You might hear this term. We call this the FCCM, facilities capital cost of money. So as I mentioned earlier, interest expense is going to have to be directly subtracted from your overhead as an unallowable cost. However, firms are allowed to calculate and add an additional amount for their federal capital cost of money. And it's based upon the average amount of fixed assets within your organization's operations divided or multiplied by a treasury rate, interest rate. So although the FCCM generally is computed as a rate based upon direct labor, FCCM should not be included as part of your overhead rate. It's listed separately, stated on your overhead rate schedule. So here's an example of a calculation. So you're going to take the net book value from 2 years of your fixed assets, averaging those out, taking a treasury rate, multiplying that to get your federal capital cost of money. So FCCM can be a part of your overhead rate charge if your customer allows that as part of the terms of the contract. All right, so recording direct labor and indirect labor. I've harped on this a lot. This is the biggest piece that you get right. While your focus of FAR audits is often overhead rate expenses and disallowances, you're also required to have a project costing and labor costing system to properly account for direct and indirect labor costs, okay? So if you're not keeping timesheets That's got to be your 2026 resolution, is to get your employees completing timesheets and completing them accurately. So every direct labor is charged to a project is allocated and separated out from your indirect time, your general and administrative time. This is going to be critical and it's going to be tested as part of a FAR audit. So it's really important. We cannot issue a FAR audit if your direct labor is not allocated properly, and if you don't have a mechanism or means to allocate your direct labor. So those direct labor costing systems are really important. You can do this if you're on a simple system like QuickBooks. There are many timekeeping software that integrates, or that you can have as a separate subsystem to allocate labor and record those as journal entries every month. That is perfectly acceptable. So, we work with many firms that are on, a Vantage Point, Deltek Vantage Point, Agera, or that work on QuickBooks. There's so many ways to track your labor. You just have to make sure you're doing it and you're doing it consistently. Okay, accounting for overtime. So uncompensated overtime is a word that we use here in the FAR world. It's for salaried employees that work overtime, but they're not going to be compensated for that. So you have to account for that on either an effective rate method or a salary variance method. If you are on a Deltek Vantage Point or Agera, it's automatically doing that for you, most likely doing that salary variance method. If you are in QuickBooks, this is going to be a little bit more of a manual process, and reach out to us, we'll help you. So specific guidance also applies to overtime premiums. So consultants must maintain records that segregate overtime premium amounts and classify them as direct or indirect costs. Consultants must establish overtime policies that are applied consistently. So you can't have a separate overtime policy for the DOT that you do for your private sector. You have to account for overtime consistently throughout your entire practice. That's something we see a lot of that you really need to change your ways for. They should be accounted for in the same method. Consultants must retrieve overtime premium costs consistently for all contracts, regardless of the customer, government versus commercial, private, etc. So you might be required, if you have field agents out there, field offices, you may be required to calculate what's called an office and a field overhead rate. So these are two types of rates that break down in your statement. So as you're, maybe become larger, doing more work, have maybe architecture work inside, and then you've got some field inspection services, you're going to probably be required to calculate this office and field rates. So types of field rates could be construction contract administration, construction inspection, project office, on-call engineers, contract employees. Field rates are going to generally be lower, as field offices do not require all the same costs as you would for your home office. So that's important to note, that field rates are going to be lower than your office rates. So what does that look like? So this is the FAR statement that I showed you earlier. And then I added these columns on here to show what a home office and a field office would look like. You'll see that our overall overhead rate is 131%. But if we break it down by home office and field office, our home office is actually higher, 136, compared to our field office of 105. So our combined rate is 131%, but our office rate is obviously somewhat higher, and then our field office rate is lower because we're not applying as many costs, rent, etc., to our field office. All right, so under FAR, management yourself is required to have some sort of knowledge and experience with FAR. You have to understand it. So you can't just rely on your CPA that they're going to identify all of the unallowable costs. That's not probable. We're not going through your entire general ledger. While we are auditors and find lots of things hidden everywhere, we are not going to find everything. And it's your job as the management to identify and segregate and remove any unallowable costs from your overhead rate. This requirement applies to direct costs as well. So ensuring that you're pulling out any direct costs from your indirect costs is really important. All right, so in establishing a sufficient internal control system, so this is really important that you can identify, segregate, and disallow. So this is important that you train your accounting staff, in training your principals, that they're recording their time properly. It's really important that they understand just because they can't bill the time doesn't mean it's not direct. Just because you can't recover it under the contract doesn't mean that it's not a direct cost. Okay, so that's really, really important that they understand that. They still have to charge that time to direct labor, direct costs. So even if a firm cannot always segregate its disallowances during the year, management should be able to estimate its FAR overhead rate by understanding the relationship to the overall firm. So if my firm historically has an overhead rate of 160%, on average, I know that our disallowances roughly run 12%. So we need to be able to identify that your overhead rate may be 12% lower than what you're showing on the face of your statement. So that's really important when you're submitting your reimbursements to your state agencies, that, just your overhead rate is not the rate, it's going to be your FAR overhead rate. You have to factor in those disallowances. And as you do multiple years of FAR audits, you're going to see that trend of what your average FAR overhead rate is. All right, so as part of this process, it's really important that you are selecting a CPA firm that knows what they're doing. I mentioned earlier, I work for the New York State Department of Transportation. So I not only work for clients such as yourself, but then I turned my hat on and I work for the state agency that's coming in and auditing other CPAs and AE firms. And it's amazing to me the things that we find. There's a lot of firms out there trying to do FAR overhead rate audits, and they don't know what they're doing. They're missing things. So what happens is you're submitting a CPA's audited FAR overhead rate, and then the state is coming through and saying you missed all of these costs, and then it's 6 months later, and now you've got to go and give money back to the state as an adjustment to your overhead rate. And that's just never a good situation. Also, when the state agency finds things like that, then that kind of loses credibility for yourself as the firm and for that CPA firm. So it's really important that you know that the firm you're working with is experienced with AE firms. We find so often that they don't know what a true AE firm financial statement should look like. So if they don't know that, they're definitely not going to be able to perform a FAR audit for you. So we work with firms there's other firms that maybe your tax returns are done by another firm, but we come in and we work with you from the bookkeeping standpoint and perform FAR audits or for FAR compilations. So that's definitely an option too. But I also say that when we first start speaking with an AE firm, it's amazing at how many things that our tax department finds that you're not taking advantage of from a tax perspective, because there are so many tax savings as an AE firm, so just research and development costs, how you're treating your fixed assets and depreciation. So, that's a little plug for ourselves. If your CPA firm, it doesn't specialize in architecture and engineers, reach out to us. We'll give you a free quote of looking through your tax returns and give you a quote on your financial statements. I'm not going to go through all of this, but this is really just outlining that the AASHTO just reiterates how important it is that you select a good CPA firm that knows what they're doing. They understand AASHTO. They've met all the guidance. There's a lot of training that we have to attend in order to do these governmental audits. It's actually a governmental audit. So it's really important that you understand your firm is in compliance with that. So when you're hiring a CPA firm, this is something I really want to educate you on. It's important that you know if your firm has a positive peer review. So just like you guys are being audited by the government, we are too. So there's this national peer review committee that all CPA firms have to adhere to that are providing audits, reviews, compilations for their clients. And you want to make sure that they have a pass, what's considered a pass peer review, really, really important there. So FAR audits can include many of the same requirements as a financial statement audit. I think people get confused. There's a financial statement audit that's of your balance sheet and your income statement and your statement of cash flows. And then there is a FAR audit, which is just strictly your indirect expenses and your direct labor. So, but we as auditors still have to follow this same professional standard that we would as if we were auditing your financial statements. So FAR audits, when you first, start talking about needing a FAR audit, you're going to be amazed at how expensive they are. And I want to point out that because they're a requirement that we follow all this guidance under governmental accounting standards. So a FAR audit roughly ranges between 100 and 150 hours. You're a professional service firm. You can do the math on that. You understand what a billable hour is, and it's a lengthy process in order to do all of the auditing we need to do. We have to look at your internal controls. We have to test payroll items. We have to test ensure that direct labor is segregated out properly, that you're charging timesheets properly. So it's an extensive audit, both on the auditor and you as a firm. So as a requirement of a FAR audit, we're going to execute an engagement letter to you. So if you've never had an audit, expect that you're going to have an engagement letter that you have to sign. It's going to outline the environment of the operations of your firm. You're going to have to understand that we're going to test internal controls. We're going to assess risk, potential fraud risks of your company. We're going to perform substantive tests, including testing overhead costs, potential disallowances, testing payroll processing, posting between direct and indirect. We're going to test compensation. So it's really important that you have all of your ducks in a row before needing an audit. So we like to work with firms a year in advance to needing this audit to really ensure that they're ready for all of those internal inspection that we're going to need to come in and do so that you're not resulting in all these audit findings. So the biggest piece that we're going to be issuing as part of our FAR audit is this FAR overhead report. So this will be at the front of your FAR audited statement. It's going to break out our opinion and establish your responsibilities as management, our responsibilities as the auditors. So this is the most important piece that the state agencies are going to read and make sure that it's an unmodified report and that your statement for indirect expenses, direct labor, and overhead rates are all materially reported. We're also going to issue an internal control report and a compliance report. So in addition to the FAR, we're going to issue this statement that your internal controls are in compliance with governmental standards and that we didn't note any control deficiencies. If we did note in a control deficiency, this is where we would note that. And this does get issued to your state agency as part of your FAR audit. So really important that we focus on ensuring that all those controls are in place prior to needing that FAR audit. And this is what one of those reports look like. And again, I'm going to provide all this to you so you can read this word for word if you so choose. So in conclusion, there is a question. So I'm going to look at that for step one for the firm to do your own calculation to get FAR overhead rate. Oops, sorry, this is jumping. For the firm to do their own calculation of FAR overhead rate, and then it's an audit required of participation. Okay, so you can calculate on your own your overhead rate. Okay, so that's really simple. If you're got a proper chart of accounts, you're segregating your direct labor and indirect labor, it's going to be very easy at the face of your statement to calculate your overhead rate. Okay, so what happens when you need this FAR audited overhead rate? That's a different piece. So they may say you need a FAR rate. That's different than a FAR audit overhead rate. Okay, so your FAR rate is you going through and finding all those disallowances we talked about: bad debt, interest expense, any advertising, contributions, taking that out of your indirect expenses, and then calculating your final FAR rate. If they say you need a FAR audited overhead rate, that's when we come into play. So we actually have to come through and do a full-blown audit your internal controls, do a ton of payroll testing. That's what a FAR audited overhead rate is, okay? Now, we work with a lot of firms that don't need an audited rate. They just need Charla to come in and say, hey, I don't really fully understand this FAR. My direct labor is not segregated. I need your help. So we also come in those situations and try to help you build your chart of accounts, clean up those chart of accounts, help you identify what some of those disallowances might be, and so that you know what your FAR rate is. So sometimes firms, like if you work with Office of General Services, OGS, so they are going to not require an audited overhead rate, but they want you to fill out that multiplier form. You're going to have to understand that your costs are segregated properly so that you can fill out that form. We can help you there. So give me a call. So hopefully that helped answer your question on that. Yeah, and again, like if you're just starting to get into this market, it's confusing and it's hard and it's costly. We have, some consulting services that we can provide you that's at a much lower cost than that full-blown audit. That's a good starting point while you ramp up contracts with any of these federal or government agencies. So we can work with you on that. All right, so I'm going to wrap up because I see my time is expiring. So in conclusion, performing services for government clients can be very profitable for AE firms, but you need to understand the complexity of working within this environment. So one complexity is that requirement of management to develop that overhead rate like we talked about. So you're going to need to contract with a CPA firm either to help you guide you through that process to get that initial rate, or maybe you're already at that point and now you need that audited overhead rate. We can work with you on both. All right. So in AE firm, you're going to have to consider aligning yourself with a consulting firm that has expertise. That's us. That's us here at Dannible. I wouldn't be here selling myself. I wouldn't be remiss if I didn't sell ourselves a little bit more. My marketing department's listening. You're welcome. Reach out to us. We are, experts in this industry. We can assist you in calculating your FAR and really helping you ensure that you're when we say maximizing that overhead rate, we mean that we're getting you every dollar out of those existing overhead costs that you already have incurred. I want to show this slide one more time because we do have those seminars that are really helpful if you're in that phase of ownership transition. We have a great team here that provides full day and half day seminars on ownership transition. So again, I'm going to provide this slide to you so you'll have that. I do have some upcoming webinars that I'm going to be talking about restructuring your financial statements to be in accordance with standard AE firms. So if you want to join in for that, if your financial statements look to be a hot mess and really aren't even close to being considered for FAR, attend that. I'll get you out that date. And then I have one that talks about not only preparing your financial statements so that they're in accordance with AE formatting, but also really analyzing your financial statements, comparing yourself to industry, what's some key ratios that you can look at. So I've got 2 more webinars coming up that I'll send in an email to you so that you can sign yourself up for those as well. So we're here for you at Dannible McKee. Certainly, hopefully we've proved to you in this one short hour that we're experts in this industry. We're here to help you make that transition into the government world a little bit more smoother. So reach out to us if you have any questions. Here's my contact information. Again, we're going to send you a follow-up email, so no worries there, but appreciate you spending your time with me today. I think, well, there's one more question, so I think I have 1 minute, so I'm going to do that. If there are add-ons to QuickBooks for FAR chart of accounts, could you mention that? So there's no add-ons for QuickBooks chart of accounts. It's all there for you. We just have to tailor them. It's totally customizable. So we do that a lot. We go in and we really help restructure your chart of accounts within QuickBooks so that you look like you're using, Deltek or Agera. We can structure those financial statements so that you're looking at that gross revenue, that net revenue, direct expenses, direct labor, and direct labor. We can help you in that area. So just reach out to us. No plug-in for that. It's just all right there in QuickBooks. Again, if you're a small firm, there's no reason that QuickBooks can't work for you. We can tailor it to make it specific to your company. So. All right, well, thank you all. And oh my goodness, all these other questions popped up. So I'm going to respond to you, the 3 of you. I didn't see them, sorry. I'll respond to the 3 of you separately. I apologize. There was a whole other screen that just popped up. So thanks again. And, Kimberly, Yvette, I'll reach out to you separately. Thank you all.